Cathie Wood. She's back uploading on YouTube despite the fact that her flagship fund is down 62% from its peak last February. Her strong opinions have been extremely polarizing lately, with many prominent investors and TV personalities calling her delusional and some even going as far as saying that she's a fraud. In today's video, we explore her rather wild opinion regarding the economy and go into detail on how she plans on mounting her massive comeback. We start with inflation. Cathie is one of the few people who still maintains that this inflationary environment we are experiencing is transitory. Even though it's been almost 2 years since the start of these wild price shifts, ARKK believes that all of this will subside and give way to deflation. The theory is that after several decades of investments, we should be seeing a large deflationary effect on our economy because technology is rapidly changing the world on a level never before seen. The only problem with this is that technology hasn't lived up to expectations. The talk 5 years ago was that right now we'd have driverless cars and taxis, truckers would no longer be necessary, and automation would improve so much that the government would need to step in and give people UBI because robots would take over so many jobs. None of that has happened, and it doesn't look like it's going to get any better anytime soon. But like all things Cathie Wood, she maintains her opinion no matter what the situation is. Her answer always comes down to one word: innovation. With inflation continuing to spiral out of control, her stock is down nearly 70%. Now, with another crisis unfolding in Europe, one that looks like it's going to shake up the commodity markets, the situation for her fund is currently dire. As I mentioned before on this channel, Ukraine supplies 12% of the world's wheat and 70% of the world's neon. This rare gas is extremely important in the production of computer chips, which are already in short supply. On top of this, Russia is being sanctioned, and as the world's third largest oil producer, this entire event is going to push prices even further to levels we haven't seen since the 1970s, and the already struggling supply crisis is just going to get worse. The situation is so bad that Cathie ultimately admits that her flagship fund will likely continue its path down as the market panics to these recent developments. Take a listen to her make this shocking admission.
We believe what's happening in Russia and the Ukraine right now is turbocharging the shock to high valuation stocks that began last February when we were all getting vaccinated, and hopes were that the economy would continue to gain momentum. And so we now believe that Russia and Ukraine have turbocharged that shock and actually hopefully moved it into a period that is very cathartic and helps people understand that what's going on right now, from our point of view at least, is that the higher interest rates and higher inflation are acting like taxes on the system. And we've been talking for a while about this, about consumption slowing down dramatically. If you look at retail sales, and I'm talking about real retail sales, take out the inflation, and real consumption. We've seen a dramatic slowdown since October, and we are beginning to see inventories pile up. All of that is working out the way we expected it to. Our surprise is that many economists and strategists out there aren't putting two and two together. They're paying attention to other variables, which there is conflicting evidence, but they're paying attention to other variables that support their point of view.
So where is the positive in all of this? Well, I'm not sure there is one in the near term. There is an argument to be made that when energy prices and supply constraints make everything expensive, the push towards innovation will increase. For an example, if gas prices are $6 a gallon, that will surely make consumers look towards companies like Tesla for an alternative option in the future. But this may be 5+ years down the road. This price shock in the near term is going to hurt the economy and consumption overall. The markets won't appreciate this fact until we go through a recession. Even Cathie can't avoid some of the alarming stats coming out of recent reports. For an example, the inverted yield curve. Without getting too technical, one of the best things economists look at to predict a future recession is something they call the yield curve. If you look at this graph, you can see that nearly every single time the yield curve has inverted, which on this graph is signified by the line going below zero, what followed was a recession. It's the go-to stat in predicting bad news. Right now, the yield curve is not inverted, but it's starting to move in a way that has many concerned, including Cathie. If the direction doesn't change in the short term, we are looking at the most reliable alarm going off in 2022. Take a listen to her admit this.
Now, what's been very interesting is the yield curve, which peaked in March of last year at, I think, roughly 160 basis points. So the difference between long-term interest rates and short-term interest rates, 160 basis points. And that was a reflection of easy monetary policy. Short rates being much lower than long range. Now that the fear is that the Fed is going to increase a number of times, we're seeing short-term interest rates up a lot, certainly in the context of recent history. But long rates not going up as much. And so the yield curve has compressed to 25 basis points. Now, we're getting close to an inverted yield curve, meaning long rates below short rates. And that is often a sign that the Fed is too tight and real growth is going to disappoint and inflation is going to be lower than expected. We think that is the case, and we've thought so for some time.
Next is another indicator that seems to be pushing many to raise their eyebrows. You see, nearly all things in the economy come down to one thing: energy. It's the ultimate commodity that dictates everything. When energy prices skyrocket, what usually follows is a recession. The stat many like to look at is the energy as a percentage of GDP. This reading is essentially a measure of how much importance our economy places on energy, and when this percentage is extremely high, what follows is typically a bumpy period where we see a downturn in the economy and market. Right now, that number is set to shoot up because the price of oil is rapidly accelerating to record-breaking prices. A barrel of WTI crude is $112, up nearly 3 times what it was just 2 years ago. Now, with so much supply being constrained, many experts are predicting record-breaking prices, just another indicator predicting bad times ahead. Take a listen to Cathie explain.
One of the metrics we keep our eye on is energy consumption as a share of GDP. And that is reaching a high that we have not seen since 08-09. And every time it has reached that level, it's again this question of purchasing power and consumer sentiment. Every time it has reached that level, we have gone into recession.
So if these indicators are all pointing to even further problems with the stock market, what makes Cathie so optimistic about her fund, which is full of companies that are rather unhealthy from a balance sheet perspective? These are growth stocks relying on the fact that investors believe their revenues are due to explode in the coming months and years. If further trouble is ahead, and even juggernauts like Apple, Berkshire, and Google are set to struggle, can you imagine what is going to happen to her ETF holdings that are filled with these small caps? This 60% drop could easily turn to 80 or 90% given her very own words, which suggest a massive downturn in the economy. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed.